All right, everybody, welcome back to the Cashflow Chronicles. I'm here with Christopher Patel. We're early today. It's a nice little feeling to be a little bit early. I came in and Mr. Patel was already here waiting, ready to rock and roll. Fresh cut. Don't think I didn't notice with the hat on there. Poor Chris. He can't get past me. Anyway, anything to say before we kick off with a great intro, as always?
Nah, man. Let's just get on with it. Let's
All
do it.
right.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.
All right. It's another great day to be here with Mr. Patel. It is June 13th. Believe it or not, since we last chatted, Nvidia did a stock split, a 10 for 1, so it's now $130 instead of over $1,000. Bros just under $39. Apple on a tear after their AI day the other day. SPY, can't believe it, it's above 5,400. Q's on a tear as well. Palantir hanging around at 23. Google still hanging out at 175, $10 below my price target for the end of the year. Amazon 183. Bitcoin taking a little bit of a retracement. And oil surprisingly hanging in there despite all the latter half of the decade bearish sort of talk that's been going on in the news the past couple of days. Natural gas hanging out at $3. Henry Hub. So, Mr. Patel, we've done some good swing trades since we last met on Sunday. I can just bring it straight up, or we can talk about something else. All right, very good. Let me get my screen ready, and I want to hear your guess as to how much we are up for the year to date, because that's going to be a fun one. Let me just double check all the accounts.
Maybe 36%, 37%.
We'll see, Mr. Patel. We'll see. I was surprised. It just keeps getting better and better. It will be down tomorrow, though, slightly, unless the market goes up, because we were down about 1/3%. But this is organized for everybody that's on the chit chat by current value. So the largest positions are at the top, and then it slows down all the way to cash. We are fully invested right now after some discussions this morning. Mr. Patel, anything crazy that you want to chit chat about?
Yeah, man. Tellurian, that was a perfect in and out trade. We made good money on that. Goddamn NextDecade bastards.
Mm-hmm.
Hate that company now. Not because I actually love the company, but they announced a new partnership with Saudi Aramco. Was it Saudi Aramco or ADNOC today?
No, ADNOC was a couple weeks ago. Aramco was today. Train 4.
So they announced a partnership with Aramco for some of their capacity. So, yay! Looks like that's gonna get trains 4 and 5 up and running. So, the sad part is we should have hit it a little harder, but I don't have any regrets. You know, we still made some good money on it. Yeah. I like I said, I wish we had invested a bit more, but in hindsight, everything is 2020. I do think we should continue to dollar cost average into the position with our dividend payments. Yeah, so this way, that'll be a nice little core portfolio position going forward. So, you know, everyone's looking at Nvidia and all these high growth names to make good money, but in my opinion, sometimes you just have to find some companies like this that have some, you know, some risk in the future, but make good money now. The only thing I'll tell someone in the comment section was like, "Oh, I'm just gonna buy at the money leaps on NextDecade." Okay, if you want to, but that's not the way I'd go about it.
It might be tough.
Yeah. Just the thing is, like, they're not even in production. You don't know what's gonna happen. So I don't know. I'm not a big fan of trying to time events like that. So I'd say and the stock is cheap, by the way. Not cheap as in like because it's still
which one, Tellurian or NextDecade?
NextDecade.
I still think it's cheap for sure.
I wouldn't go that route, but yeah. But let's check out our portfolio. What's going on?
So Chris messaged me. What was that? Was that Monday morning? Or was that Tuesday? Regardless, we had a chit chat. I guess Chris is coming off his night shift and looking at the stocks, the news that was out that Tellurian was starting to move up a little bit. So we had purchased about, I forget what we sold, Chris. I want to say we sold a little bit of HIMS. I think we took another 5 shares of HIMS. I think we might have took another share of Snowflake off or we sold out of Snow. I forget what it was. No, we sold Snowflake last week. But then we sold a little bit of HIMS. So anyway, we had a couple $100. We bought 550 shares of Tellurian. Now you'll see that on the screen, we have 150 shares left. So it was, I think when it got into the 85 range, we had a sell for 85 cents for about half the position. So I think we sold about 250 of the shares. We retained 300 shares. And then it was, I guess it was this morning before market, I'd sold another 150 shares for another 83 or 84 bucks, 84 cents. Sorry. So I think maybe it was a little lower. Maybe it was in the 70 cents range, but regardless, pretty good swing in and out. And then we took some of that profit and we bought 2 shares of Snowflake. And then we bought, and that was yesterday or 2 days ago. And then we bought today with the proceeds from that 150 share sale of Tellurian. We bought a little bit more NEXT. So it's nice to have a little bit. I have more in my personal portfolio than this, but it's nice to kind of see it. And I agree with you. I was just doing the numbers in my head. So I always thought for NextDecade, and I won't talk about it too much, but I always thought that trains 4 and 5 were going to be sanctioned together. And it really looks like they're just going to sanction train 4. And even with just train 4 alone, it looks like it's probably going to be an additional, right? Not total, but additional 500 million or so in distributable cash flow. So if you think about it, the company right now is worth 2.5 billion. So just that, and basically what they stated, they basically all alluded to, but FIDing train 4 with this deal that they did with Saudi Aramco. So now that Saudi Aramco is purchasing the like 1.5 million tons per annum of LNG, that pretty much makes it so that the revenue stream and the contracts are sufficient enough where they can get financing for train number 4. And the reason why it's important is because if you guys remember, I believe Next owns 40% or slightly more than that of trains 4 and 5. They don't own nearly as much. I think they own less than 20% in trains 1, 2, and 3. So while they are the constructors of the project and they'll get some cost recovery associated with being the operators of the project, of course, they only own 18%. So therefore, trains 1, 2, 3, not nearly as profitable versus trains 4. You have all that additional infrastructure you have all that infrastructure that's already in place. Now you're just investing in strictly a train. You don't have to invest in, say, the port because the port's already there. You don't have to invest in the hookups because the hookup's already there. It's literally just the compression train to be able to compress more gas and get into storage, etc. And that's all it is. So it's almost like a incremental project. It's like adding another drive-through window to an existing McDonald's location, right? You have more ability to take more orders, right? Mr. Patel, did I miss anything? I know there's a lot of other moves that we did.
No. We also bought some TMF, which was a good move on our part as well. Anticipating some of the drop off in the higher, what is that thing called? Drop off in longer dated bonds. So this way we had I wouldn't say a lot of return, but a good return in a very short period of time. But yeah.
And then we also re-entered Snow a day or two ago. At about $1.28 or something like that. It wasn't too, and we just had extra cash, and I think that the bottom was kind of in. Maybe we're a little bit too early. We'll see, I guess. But 125 versus 128, it's the same price to me. So
yeah.
Somebody's asking if we still have Bros. So we did sell Bros from the portfolio, but I still have it in my personal portfolio. I think Chris had many other plays. I don't think he ever. You might have dabbled in it for a little bit, but you've been out of it for a while.
Yeah, I've been out of it for a while.
Yeah. So I'm trying to think of anything else, Mr. Patel. We're getting close to 100% return on TQQQ. That is one that I hold pretty expansively in the personal portfolio, so you can imagine
Nice.
how I'm doing with that one. That'll be my yacht fund in the future. Let's see. Rocket Lab's finally back in the green. Okay. We're doing pretty good, Mr. Patel. All right, so locking in your final guess. I can't guess as to what our year to date is, but
I don't know, 38%. Let's say.
what about in the chat? What does the chat think? What are we thinking for the year to date, considering we've done pretty well over the past couple days? I'm curious what exactly everyone thinks we're at. But yes, I did. I don't know if Amit bought Rocket Lab because of me. I think Amit sees too many people talking about it, so he's ready to.
He got bored. He said he was bored.
Yeah.
All right. Someone's like 39, 42. All right. We'll see.
Thought I clicked it. 37.6.
Ah. All right. I was literally just a little scotch.
But it's double the S&P.
Yeah.
So
it's a little. It's more than double the S&P.
I know.
Yeah.
So yeah, it's a good time. I'm excited. The portfolio is doing rather well. I just wish we had more cash coming in. So we'll just have to make sure that whenever YouTube allows us to monetize this damn thing, that we actually get that done.
Get some, yeah.
Because that'll be nice. That'll be a couple $100.
You know what our new goal is? To beat Joseph Carlson. That's it. Like that's the goal now. Because like
you just don't like his banter on Twitter. Is that
no? He's fine. I just like he sets the target high because he's at like 625,000.
Okay.
Let's see if we can, we can get to that level and do it sooner than him. Because remember he's built out his portfolio over like I think a decade now.
Yeah, he's been doing it for as long as I have. So he has a pretty good channel. I'm surprised he doesn't have. Well, I really like his content. He does a really good job, right? So I'm not bad mouthing him, but and he's also a really smart guy. I think he was a computer scientist or an engineer or something before he went. I think he's full time now, YouTube, but I'm surprised he doesn't have more money than I do, to be honest with you. Maybe he does. Maybe that's just the public portfolio. So
I think that's probably like personal portfolio. Well, he has a lot of different funds. Yeah, that might be the case.
Yeah, that might be the case. Maybe he does have more money than that. But he does a great job, and he's done it with some like I don't want to say mom and pops, but Costco is one of his longer term ones, and he doesn't do as many flashy ones. He does more of like hey, this is a good value stock. I don't think you're gonna get burned by buying this. So he does a good job. Yeah. But yes, what reason? Just because it's somebody to go after. Not go in a mean way.
Just someone to friendly competition. Yeah, someone to benchmark against who's like not the S&P 500. Because I mean, yes, we are always going to have the S&P 500 as the benchmark that we need to beat, but there's also like, okay, there are other people on YouTube who are we going to like use as our North Star? And I think Joseph Carlson has made consistent returns over a long period of time. You see, anyone can beat the S&P 500 like we did within the last 30, 60 days, 90 days, whatever. But can you do it consistently over a long period of time? That's the mark of a good investor.
Yeah.
I personally have had a couple of rough years in my early days investing, but I'm beating the S&P. I've beat it multiple times. I'm killing it, believe it or not. So, but I had to change a lot of my investing style over the course of my investing journey a little bit. I've learned a few things along the way. I've applied those, and once I apply those things, I start to realize that, hey, you know what? Investing is not as hard as a lot of people make it out to be. So here's an example of something that I'd say, is worth, I guess, I want to call it a life lesson, but something worth taking into account. Number one, have you ever gone hunting, Matt? Like,
yes, I have.
Okay, what have you gone hunting for?
Pheasant, deer, small game, just walking around drinking beer.
What's the best time to go hunting for deer?
Fall time. Yeah.
Fall, right?
Yeah.
Now here's the thing: can you go hunting for deer in the spring?
I don't think you can technically, at least.
No, I'm saying like if without the rules and regulation.
Oh yeah, for sure.
What about going it during the summertime?
Yeah.
You know, now the reason why I say that is because there are certain seasons when there are plenty of deer in the forest that you can shoot. And then there are times where there's not as many deer, right? We're getting to the point right now that based on my investing style, I don't see a lot of opportunity out there right now. As you know, I don't know if you're seeing the exact opposite, but you know, when you pull up the, let's say the S&P 500, right? Let me just pull up here. Let me just bring this up. Sorry. You're gonna have to give me a pause. Okay, so let's take a look at this. So you look at the S&P 500. Okay, this is the S&P 500, and I'm trying to find one that just shows the forward earnings over a long period of time. Okay, here we go. You know what? This is good. The S&P 500, of course, always moves over time in a certain direction, where it moves in up and to the right. That's why everyone who's a index investor, they make money because they're just invested in the whole index. They're like, yeah, whatever. I don't really care about trying to pick individual stocks. Not my thing. I just want to be invested in the index. And that works. Believe it or not, that is a consistent winning strategy. All right. So if you are young, if you're in your 20s, you should have an S&P portfolio, like a very small amount, but you should have an S&P portfolio. Just buy the goddamn index. Don't look at it. Just, you know, like it's going to be up and to the right. You're going to do fine. It's going to be great. But let me just say this very carefully. There are times where you make a lot more money by being in the index. And there's times where you don't make as much money being in the index. Now, what does that mean? Now, if we look at this chart right here, if you bought the S&P 500 index right here in the year 2000, right, when the dot-com bubble was happening, if you look at on a forward valuation basis, you basically bought at the top. And now you underperformed for a long time, probably until about 2008-ish. So, you know, when you buy is very important because, you know, you'll be sitting on dead money for a long time if you buy at the top. So that's exactly what happened. People who bought the index at the top basically sat on dead money until 2008. Now, that doesn't seem like a lot, but that's 7 years worth of flat returns. Okay. So we have to keep that in mind. Again, in 2005, well, not 2005, sorry, 2008, around the great financial crisis, you know, that one, the market was not overvalued, but we had a black swan event that caused the market to really get depressed and just really went down. And the valuations had compressed so much, you could have bought anything here. Okay. I'm talking about multiple industries, and you would have made really good returns over the course of the last 14 years. We're getting to the point right now where there was this dip that happened around COVID. So, you know, you saw this giant dip where valuations just absolutely went stupid for like a very short period of time while everyone negatively reacted to the news. But then you saw a quick bounce back with all the stimulus spending, right? And then we started to have this downward decline in 2022, primarily because everyone was worried about inflation, Russia invasion, and blah, blah, blah. So we saw that reset. And then what we realized was, hey, this is actually manageable. The Fed, you know, for the most part, had to do what it had to do with its policy. But for the most part, the consumer stayed strong and we got a nice bounce back. But what you're seeing now is, from a valuation standpoint, we're at I wouldn't say a high, but we are higher than a point where it makes sense to be in a more riskier position in the market. You know what I mean? Yeah. Like right now is not the time you want to put a lot of risk on. You know, definitely still buy the index. You know, over time you'll be fine. This is not me saying we're going to crash down here again and everything is going to, you know, go back that way. No, it just means that, you know, you have to be a lot more selective with the companies that you buy. Now, what does that mean for me and you as investors? Number one, I would not be buying Nvidia. Okay, I think it's at the top of the range when it comes to its valuation. There still might be a lot of room for growth. Okay, so don't get me like, oh, look, every day Chris is in Nvidia, and look now all of a sudden Nvidia is doing what. Congratulations, enjoy your wins. I'm not saying don't buy Nvidia. Okay, if you think Nvidia has a nice, long, bright future ahead of it, and you want to get in now, go right ahead. Totally cool. But I also think right now there are not a lot of places where we can be very opportunistic. The one place I think we are able to be opportunistic is in three different companies in the short to medium term. One of them is Snowflake. I think Snowflake has gotten oversold primarily on the back of three things. Number one is uncertainty because we got a new CEO. All right. So that's anytime you have new leadership, the market always like, hey, listen, I knew the old guy. I don't know you. I got to give you that kind of valuation, like knockdown, so that's number one. Number two, they have been guiding for a very anemic growth cycle this year. Now, last quarter, they actually beat their guidance, right? But essentially, they gave a very, very conservative guidance. Now, the thing is, most people, they're going to take the company at their word and say, look, if you're being conservative, you're being conservative for a reason. So we have a conservative guidance, which also, once again, from a valuation standpoint, gets a little bit of a knock. And then last, they had a data breach incident recently that can cause some reputational damage, but also like make investors think twice. So once again, the short-term thing that's happening is giving them another knock again. Now, right. All three of those things can reverse. And that's why I said, let's buy Snowflake. So number one, the impacts of this MFA thing, I think slowly over time are going to dissipate, primarily because it wasn't actually Snowflake's core problem. It was actually the other side, which basically did not follow the correct best practices in order to safeguard their own data. So basically what happened was I'll explain a little later. I'm not, well, you know what? Let me just do it right now.
Go on, King. No, I'm just kidding.
Whenever you log into something, you can just log in with a password, or you can enable something called multi-factor authentication. Now, what is multi-factor authentication? It means that you get a little message on the phone that, makes you approve like that. Hey, are you actually the person trying to log in? Yes. And then, so that's another login factor. Another thing that you can do is have like applications that are constantly changing encryption keys, where you go to the application and the encryption key is there, which means that you can log in. It's a second check against someone logging in. So now it's actually become industry standard practice to do that, but Snowflake did not require some of its clients to do that, and so those clients, their accounts got hacked. And so some people are like, oh, this is Snowflake's fault for not requiring MFA as a default. That's not the case. It's almost like a seatbelt, right? Like if you're driving around a car and the manufacturer has a seatbelt in it and you don't wear it, you can't sue the manufacturer and be like, oh my God, like I got into an accident, I got hurt. Well, were you wearing your seatbelt? No. Okay. Then it's your fault. It's your problem. We have to get around that, so that's another thing, but that will slowly dissipate. With regards to its guidance, I thought it was always a conservative guidance. I think they're going to do very well going forward. So they're going to have multiple beats coming. So that'll be another like nice valuation boost. And then from what I can see, the new CEO is really like up into the right kind of guy, where he really wants to get products out into the market. I think, over time, he's going to have to prove himself. But once he proves himself, people will take away that knock that the company currently has. And when that happens, it'll rise, back to somewhat of a reality again for its total market potential. So yeah. That's that.
I think the worry that I have with Snowflake is, and I agree with you, last year they guided for either very slight growth or anemic growth, and look what happened to them last year, right? They still grew revenue at a massive pace, and this is in their second quarter, right? Remember, everyone was trying to say like, oh, layoffs are happening. Everyone was all about efficiencies, and here we were, everyone is like, the CFOs are pulling back all the technology funding, so don't expect us to be growing in the second half of the year. Lo and behold, they grew pretty well last year, right? So I hear you when it comes to them kind of under promising and hoping to over deliver when the actuals come out. The thing that I'm most concerned about for Snowflake is they're trying to go the Broadcom and Salesforce route of acquisition to be able to bolt on and really gain a lot of revenue growth and talent.
No. The acquisitions that they made have been acqui-hires. None of the companies that they acquired have come with durable revenue streams. So
okay, that's fair. That's fair.
Yeah.
But either way, I mean, you have to think there's a lot of integration and everything that has to happen for that to go successfully, right? And so that's my kind of hope is that, so maybe it's not exactly like what I was describing, but regardless, instead of growing talent organically internally, they're doing it non-organically, which has a lot of efficiency potential problems going into the future, right? And if they do it well, then I'm sure they'll do phenomenally. But that's the thing that I need to see, coupling that with the new CEO, right? That leaves a lot of risk, and I think that that's what's being observed in the stock price now. If all that risk ends up being something that doesn't actually come to fruition, and everything starts going smoothly, everything integrates well, they actually start ballooning up in AI revenue, and all is fine and dandy, then I have a firm belief that you'll see the stock price go back into the high 100s like it was, just a few months ago. So curious to see what ends up happening with that one.
So one thing, just to make everyone aware, when you look at something like Broadcom buys companies, finds where all the inefficiencies are, strips them out, gains huge durable revenue going forward, and also expands their margins on the companies that they buy. So that is how Broadcom does really well. And they're really good at identifying companies whose value the market is not recognizing and then making the transformations happen. So Broadcom is it's an amazing company that does that. Salesforce used to be like that a little bit until their acquisition of Slack, which didn't pan out as great because I think they overpaid for it. But Salesforce is another one that has been basically anytime their growth is slowing down, they usually do a serial acquisition, in which case that boosts up their core product offering and then goes forward. So I think Snowflake is trying to build something more durable. But one of the things is, when you think about trying to grow organically, the one thing that you don't have right now that Snowflake does not have is a whole lot of time to get as much market share as possible. You have a lot of people migrating their data warehousing needs to Snowflake, and you want to keep up with those migrations. Now, the thing is, once people migrate their data onto your platform, it's really sticky and it's hard for people to get out. So it's not like you can just switch data warehousing from one thing to another. So right now, yes, Snowflake is sacrificing some margins by hiring expansive sales teams, but they know that they want to get in as many doors and as many companies as possible and turn them into default Snowflake houses. And it's a winning strategy for the long term. In the short term, it seems painful. So I'm not necessarily worried about Snowflake when it comes to that. The only thing I will say is there are other companies in the wings like Databricks and even like the main cloud providers that are competition. So, Snowflake really has to outperform their core offerings. But in terms of valuation, I think we're in a good place. So that's why I think Snowflake is a good buy at these prices. So yeah.
Definitely think there's potential for Snowflake, and it's something I would watch out for. I personally, although we're buying it in the public account, that's a Chris play. I personally would wait a little bit more to see some of these risks kind of fall out. But sometimes I do invest in things like this 6 months way too early, and end up writing it down, especially if you're thinking about dollar cost averaging and you have something that you're wanting to put in. And that gives you the flexibility, right? You have to think about how your portfolio is structured. So I know Chris was kind of talking about having a a solid position in SPY, and then thinking selectively at what times is it easy money to be able to put money into SPY, what times do you need to be more selective about the opportunities that you choose. But that gives you the flexibility if you're adding capital every month to really, take advantage of when companies go down in price, especially if you have the conviction and especially if you're actually reading the reports, because a lot of times companies will trade out of favor for things like this, right? You have to think the company Snowflake in particular went public. It was a rather cheap stock when it went public. It's now ballooned up into the hundreds of dollars. People are probably taking their profit at this point, right? They say, Slootman's out. I can't forecast the future. I could with Slootman in there. Now it's time to take a little bit of a breather. That's an opportunity, right? That means a lot of hedge funds might be selling out, and it might be warranted, but it also might not be. And these are the things that you have to look out for. The market gives you these opportunities every once in a while for certain stocks, and sometimes it's warranted and sometimes it's not. And I guess you just have to look and say, am I willing to risk it? Should I wait till Q2? Those are questions you have to ask yourself based off of your risk tolerance and how you're looking at this, and say, is this an opportunity where people just took a lot of profit and it's an opportunity for me to get in both feet? Or is it something where, I'll trickle in over time and realize that those risks are still kind of present going forward in a couple quarters? And if they are, then you're not so hurt, right? Versus if you go both feet in the pool immediately and you end up getting caught with your pants down, well, unfortunately, you kind of got screwed and you can't really make a difference. So it's all about how you structure your portfolio, how you move in and out of positions. I generally, depending on what kind of company it is and how big of a position it'll be, if it's a company that I have a lot of conviction in and I haven't already built a position, I'll maybe put, I don't know what's a big position for me anymore, but I try to keep everything below kind of 100,000 for big positions. But most of the time I'll end up putting 15 grand into something. That's kind of like my teaser rate. And if I continue to see value in it, maybe I'll end up having the ability to put more money into it, but it could also be I'm consolidating elsewhere and then I have this excess cash and I'm putting it into here. But anyway, I personally would wait another quarter before I looked at Snowflake, and that may mean I miss out on gains, right? Versus other stocks, I foresee, the fact that I'm willing to be early because I don't want to be late to the game, like Rocket Lab, right? So I'm not saying it's a perfect one size fits all strategy. You kind of just have to do what's right for you and the risk tolerance. Mr. Patel, I thought it would be a disservice to not discuss the inflation that came out yesterday. I don't want to put you on the spot, but I was confused. Shelter was up compared to what you were kind of thinking. I thought you were thinking that Shelter would be coming down slowly. So I'm curious to hear your thoughts about all the different things I can click and turn on. This is basically looking at 12-month percentage change.
So just go to
individual category.
Go to Shelter real quick. Let's take a look. So first, Shelter was not high. Well, it's not leveled off. It's still going down, but the pace at which it's going down has actually beat. The pace that everyone predicted that it would go down has not gone down as fast. Now, how do we know that? Well, one of the things is the Federal Reserve of San Francisco. They produce a report for this specific thing. Let me just bring it up real quick. Hold on. I was actually looking at it today. Damn it! I put it in the Patreon, but damn it. Actually, let me just bring up the Patreon. Let me just bring up my Discord.
Mr. Patel does that. Everybody, if you have not already, please feel free to subscribe. It is completely free. We try to do streams once or twice a week as we kind of get back after it. So yeah, we've been having a lot of fun with season 2 already, and the response has been great. Every single video for the past 3 or 4 videos has been over 1,000 views. So that's really great for us as we're kind of getting back into the groove of things. So I appreciate the support and love the comments. So keep it up.
Okay, so this is basically what the San Francisco Fed in their projections. I put in the red. I actually been filling in the dots a little bit, but basically, according to them, when they made this prediction last year in May around this time, This was their forecasted model. So by 2000, what's that thing called? For 2024, by May, shelter was going to have rolled over, in which case we saw basically flat year over year growth in shelter to actually starting to go negative. That does not seem to be the case, as shelter's kind of like been a little bit more, stronger than what people had anticipated. Now, here's the thing. I don't think that they were necessarily wrong in their assertion that it would go down. They definitely got the velocity wrong, but I think there's a reason why they got the velocity wrong. And it's very simple. One, if you look at what happened last year, when they made that prediction in May, inflation was coming down and coming down fast, right? And then we got June and July, where literally we had spikes in energy prices. And because we got spikes in energy prices, we ended up seeing CPI start to climb again. And so what did the Fed have to do? The Fed had to once again start raising, and then kind of like, basically took the winds out of the disinflation narrative. That was bad for us. But at the same time, what it did was it caused shelter to remain high because the Fed was not able to cut fast enough. You know what I mean? So what happened was, right now there are a ton of people sitting on sub 4% mortgages. They're not going to be selling their homes. So the inventory is locked. Now, had the Fed start cutting that summer, like everyone had originally projected, there might be a lot more inventory of shelter in the market today with this current sales cycle. That is not happening. Interest rates are still high, and they're staying high. So what ended up happening is now that inventory that should have been building didn't build, which means now the price of homes have come down slightly. They're not at the peak anymore, but they're not down to the levels that we had originally projected out. The good thing is the rest of inflation is coming down to the point where I do think that the Fed is going to have enough ammunition starting the end of this year to start cutting. And those cuts are going to be followed up by more cuts in 2025, which means you're going to see a lot more shelter coming online in 2025. So when shelter comes on in 2025, what you're going to see is a lot of year over year numbers start to go down and into the negative zone, in which case now you're going to get yourself into a super, I wouldn't call it super, but maybe a deflationary cycle in shelter. And shelter is one of the largest components of CPI, which is basically holding everything up. So if you look at the chart that Matt is showing right now, it's very obvious that shelter lags. You can see that the top was in May of 2022 when it came to inflation on all items. But then shelter is now coming down, but it's not coming down nearly as fast. And what's good about that and what's bad about it at the same time is that we can actually, because housing is not as liquid, you're also not going to see housing prices go up again very quickly. So that's one thing. So the pace at which it's currently going down seems to be moderating, but it's still headed in the same direction. The rest of so if you strip out shelter, so can you do that on this chart real quick? Strip out shelter from this chart. So basically just do core, or actually let's go each one. Let's go at food, right? So go to food first.
Sorry, I might have to. It's not the best. You have to click away from it. But yes, let's do food at home first. Food at home.
Yeah, food at home you can see is at target, right? So we're good. Like food at home has come down. Regular food costs have come down also. So this is like a highlight. So this is back to normal again. So it's 2%. I actually looked at food. It's close to 0% year over year growth. So food inflation is down, which is good. So let's click away from that real quick. Now, food away from home, which means like at restaurants and stuff, because higher wages are keeping those prices higher, right? So the cost of hiring people and everything else has been going up because of inflation. So that's why food away from home is higher. But I think with the economy, if it starts to roll over, you're going to see that naturally gravitate back to the lows again. If we look at gasoline, the Fed typically strips gasoline out for this particular reason, because it can fluctuate wildly. So if we look at the chart, we can see that at one point last year, gasoline was negative 25% year over year growth, right? This year, it's flat, which is good. Technically, that's what we want. But that's exactly why you strip that. Natural gas is kind of just evening out. But once again, natural gas and gasoline are not helping the total inflation to come down. All they're doing is returning back to a more steady mean again, right? Electricity is the one that I'm actually a little bit surprised that it's starting to come back up again, but it makes sense because natural gas prices are coming up. So if you look at electricity prices, they've been starting to kind of go higher. And that's on the back of just a lot of demand, probably from EVs and everything else. And then also on top of it, the cost of natural gas. So if you layer natural gas on there, on electricity, you can see that electricity prices are going up, but natural gas prices have also been going up. So natural gas was negative 20% year over year growth up until probably March. And now it's actually gone up, which means that utilities, which primarily use natural gas, they're going to have to be paying higher amounts for input. So that is going to get passed on to consumers, which means if you look at electricity prices are going higher. This is why I think also a lot of the solar stocks are running. Like Enphase is doing well. I think some of the other solar companies have been doing well, primarily because remember what I said last year. There's two things you need for solar to succeed. One, you need higher electricity prices, and that usually comes from natural gas. And two, you need lower rates. So people are expecting lower rates. And they're also at the same time expecting higher natural gas prices and higher electricity price, which means the cost of solar may be coming cheaper, in which case now people are saying, oh, you know what, I'm going to buy up solar ahead of time. So that's why you're seeing some recovery in solar. But I wouldn't say like, oh my God, go ahead and go buy a ton of solar companies, because that equation can get changed at any time. As you and I both know, natural gas is one of those things that, you know, if it starts pumping again, it could be brought down very quickly.
Yeah.
You know?
And I think the reason why you're potentially seeing some of these solar stocks run, they were hit so hard over the past 18 months that, you know, many people were even walking away from them entirely. Like a lot of offshore wind folks were gung-ho, spending billions of dollars trying to invest into offshore wind. And it just got to a place where it was so competitive, it was uneconomic to do. And so now you have had a lot of people kind of go back to what they're good at, whether that's oil and gas or whether that's natural gas production. And now it's left some of the remaining players, right, that are still around, NextEra, Orsted. Now they're starting to actually get to, and even Enphase to an extent, get to a place where they're actually able to recover, because things were rated as if they were going to zero, right? A lot of these companies are high in debt. They're leveraged because a lot of this is capital intensive. So it's getting to a place now where if they survive, they're actually able to make a good buck. And also just because natural gas was so cheap for a while, I've actually seen from a recent NextEra Energy presentation that the cost to develop a natural gas power plant has actually gone up by about 40% over the past several years. And so with that, you know, being able to build a natural gas plant for 40% more, that's obviously going to have a negative impact on your electricity. So if you're able to find areas where solar, battery power, wind, onshore wind specifically, can be placed in an advantageous area at a rather cheap, you know, you're doing rather well. And I think one thing that people are leaving out when it comes to the electricity conversation is onshore wind. You're seeing a massive expansion in Siemens, as well as many other companies, come out with turbines that and generators that are actually able to massively increase the output of these onshore wind farms that were originally designed for much less. So basically what they're doing is they're taking off the turbines themselves. They're extending them up with bolt-ons for like another, I don't know, 10, 20, 30 feet. I'm not exactly sure of everything, but I know they're extending the tower by some length and then adding additional length of turbines, and it's actually increasing. So not only do you have to you won't have to necessarily impact the infrastructure, but you're able to just add a little bit of extra tower length, and then also get a higher output from the turbines themselves, greater generators, etc., and boost output by 10, 20, 30% in some cases. And it's a massive increase to your internal rate of return. And so I've heard a lot of companies, instead of expanding into new territories, actually looking for being able to do those redevelopments. And they've been extremely successful at it nationwide from what I've seen. My own company at UDOC, and then also NextEra had a really good amount of slides on it in their recent Investor Day presentation that came out yesterday. So it just goes to show you a little bit of some of the techniques people are doing to try to keep electricity down. But I'm with Chris. 50% of the grid is still natural gas, and nationwide. And depending on your state, some states have higher nuclear, some states have higher natural gas, some states have higher solar. So it all just depends on where you're at in the union. But overall, nationwide, that's kind of what this is representing.
So basically right now inflation is still on its way down, but the rate at which it's coming down is being readjusted, and the Fed is doing that. So let me show you one thing real quick. Have you ever seen this before? The Federal Reserve's economic projections, where they do the
interest rate.
for
Yes.
the board members. Yeah. So one of the things that they do is they're always constantly readjusting their projections. It helps to figure out which each board member is thinking, and then based on that, they typically make the right policy decision. So right now, this is what they're expecting, and this is good because it gives us a nice readout into the next 3-4 years and what they're looking at. But it also, in my opinion, sets us up for some targets at the upper range of things, whereby it blows their thesis, in which case now they have to readjust things. So let's do a quick example. So right now with GDP, they're expecting about 2% year over year real GDP growth. Okay. What is the difference between real GDP growth and just regular GDP growth? Real GDP growth is usually above inflation. So you have GDP growth, but then you also want to have real long-term inflation. Growth. So if you're basically growing, but your inflation is growing at the same time, you're not really growing that much. You're just basically going with inflation. So real GDP is important. More important to me, I think, is unemployment rate. So I think that they're okay with somewhat of a higher unemployment rate. Right now, the unemployment rate is 4%, but next year they're saying, hey, you know what? We could we could knock up to about 4.2%. They're projecting 4.2. So if, let's say, the economic situation deteriorates between now and then, and we start to see unemployment rise to 4.3, 4.4, that could be a trigger for them to say, you know what, we need to start cutting now. To hell with the inflation thing. Inflation will catch up, but we need to make sure we're living up to our dual mandate. Okay. Another thing to consider also is that PCE inflation, they're okay with not having 100% PCE inflation at their 2% target. There's no rule that says we need to be at 2% in order to start cutting. No, it just means that we need to be trending towards this 2% to start cutting. So because of that, they're able to adjust their forecasted federal funds rate. So if you look here in March, they were expecting by the end of this year, interest rates from the federal funds rate to be about 4.6%. They readjusted it higher because inflation is not coming down fast enough. And they did the same thing for next year. So they went from 3.9 to 4.1. And then the year after that, they're like, everything's going to be normalized, so we're fine. Now, this is, once again, that's a projection. If the economic situation deteriorates and we start to see it, fall below this model, then the Fed will have to readjust itself. And that's why if we look at the dot plot that they have, let me just bring it up. you know what? I'm going to stop with this. It's just too much to cover. But basically, the Fed is basically saying, you know what? We've got a little bit of a higher for longer situation because everything is good. We don't need to cut as much. So right now, in my opinion, one, we're at high valuations in the market.
Yep.
And then at the same time, we have the Fed pushing back, saying we don't necessarily need cuts, which means that we're in restrictive territory. Now, one of the reasons why we're in a high valuation mode, one is because the consumer is strong. It's weakening, but the consumer is strong. So that's number one. The other main reason why I think right now we're seeing some relative strength is because the Fed was maybe a little too dovish in January, with Powell coming out and saying, look, we're looking at good stuff happening, and basically kind of like made a lot of companies front run a lot of their expenses.
Yeah,
So now what you're seeing is a lot of companies, they said, oh, well, the Fed's going to be cutting in 2024. Everything's going to be great. Let's start freaking investing. Let's go. And so now you kind of like you kind of like made your situation worse by saying everything is great. So that's one of the problems that we're having right now. And so the Fed right now, so when we started the year, we were at 7 cuts. Now we're at 1 cut, yet the market is still running under the same guise as, hey, we're going to get 7 cuts for the year. So the valuations haven't reset it down. So this is, in my opinion, a risky area to be, so this is where I'd say we have to be a little bit cautious. There are pockets of overvaluation that need to be completely like just woosad against. And just I don't see a lot of opportunities in the general market. I do see opportunities here and there, like very, very, you have to be very like laser focused on the business to recognize if there's any sort of alpha that maybe the market is not recognizing with that specific company. But I don't know. As far as I can tell, all the soft targets in this market have already been hit. You got the Mag 7, which are cash flow beasts. All of them are running, all-time highs, I think, on some of them. And then you've got this whole AI wave happening. So that's kind of like leading a lot of people into those sectors. So for the most part, in my opinion, I'm kind of in like the neutral zone right now. There's really not a lot of places that I think we can put money to work and make asymmetric returns that are going to beat the market. Because at the end of the day, that's the goal, right? If we're trying to beat the market and we're not just trying to perform the market, then we need to find those asymmetric return opportunities. If we just want to be the market, we just buy the S&P and call it a day,
Yeah.
So
I still think that there are, like you said, small areas within that will outperform with cuts. But like you stated, I was expecting, I guess, a little bit more oomph towards the end of the year. I thought the FOMC would have felt like that they're kind of backed into a corner. But I agree with the data that they're saying. And I agree with the sentiment, right? I could swear in 2022, when they were raising interest rates like crazy into early 2023, I personally felt it, right? Like I personally felt like when I was waking up in the morning, things were slowing down. People were less likely to go spend money. But I agree with you. Now that people have kind of gotten adjusted and people's wages have kind of caught up, I feel like more people aren't really as, I don't know, people know that we're kind of at the peak, right? So they're more happy to recognize they're not cutting as much because they know it's more likely to go down and easier from here than it is to get harder. So I'm with you in that respect. I think a lot of people, when it came to, like we saw just in the market as a whole, right? The sentiment that we saw, I'll just pull up a graphic. I mean, it's kind of like when we really started the public portfolio, but it was, is this it? Yeah. So let me pull it up here. It's like the whole year of 2023, everyone was kind of on edge and nobody knew necessarily what was going to happen. And next thing you know, the pendulum swung when people were like, we think the cuts are coming, right? We think the cuts are coming. And now we've kind of just been here in limbo. And I think the reason why we had this slight pullback was because people were like, cuts aren't going to happen to the second half of the year. So there was a slight adjustment. But now I think we're getting to the place where people recognize, hey, we're getting towards the end of the year. Something has to happen, coupled with with earnings just continuing to go extremely well at the Mag 7.
Well, just remember one thing though, Matt. With the Magnificent 8 right now with Nvidia, a lot of this is being dragged higher by these huge returns in Nvidia.
For sure.
So the S&P 500 right now, if you benchmark this against like, let's say, the S&P 500 minus the top 8, the growth story does not look as great, especially the last like 40 50 days. A lot of what we're seeing in the S&P, like this giant rise, is primarily the Nvidias of the world. And today, Apple absolutely has been destroying it over the last few days. So these are huge market cap companies, so that are just basically keeping the market elevated. So let's, like I said, let's just look at the map real quick on the S&P.
But do you really think with rate cuts that that the Mag 8 is really going to take that big of a hit? I mean, I just find it hard to believe. And I think if anything, you'll see some companies like small regional banks, and you'll see in other companies that are really just trading close to cash value start to excel. And I think you're going to see mid caps do really well here with respect to the regional banks. But at the same time, I recognize that, I don't know. I mean, generally speaking, as not talking about this environment, but I'm just saying, generally, when rates get cut, that is not good for the markets, right? When they're talking about cuts, it means that something is going on, right? And easy ones to point out are the dot-com bubble in 2000. Another easy one to point out is 2007, 2008 with the financial crisis. Those are easy ones to cherry pick, but there's other ones across history that have happened. And I know that history doesn't guarantee future results, but I don't know. If we really are going to cut, I feel very stable here personally. Yeah. Would I love lower interest rate payments on some of these houses that I have? Of course. I'd save hundreds of thousands, not hundreds of thousands, but I'd save hundreds of dollars a month on one mortgage, potentially thousands on a whole of them. But I can afford it still. That's the thing, right? Like maybe I'm just doing well for my age, but I feel like a lot of people I know can afford it, right? And I'm not anything particularly special.
Well, right now, the core argument here is that technology, its outperformance is making the entire market, like basically keeping the market higher, right? So if we look at like the different sectors, right? And we go back like one day, you can see that the tech was up today. Everything else, like communication services like Google and stuff, they were down. So energy was a big downer. But if you didn't keep going back 1 week performance, materials was down, technology up. 1 month performance, technology, everything else is kind of like down and to the middle, but technology is keeping the market up. 3 month performance, everything else like has been kind of flat and some a little bit negative, but look at tech, right? This is the crazy thing that's happening right now, where tech is kind of just outperforming the rest of the market to the degree that it's keeping the S&P 500 elevated. But here's the problem. Any correction in this, because of, I don't know, some kind of black swan event or whatever you want to call it, we got ourselves a big issue. Because now what happens is that engine that's powering the S&P 500 higher is going to end up slowing down and stopping, right? Nvidia, as far as I can tell, can't keep growing forever. Google, Amazon, Microsoft, they can't keep growing forever. Or at least they can't keep growing at the same degree that they have been growing over the last 6 to 9 months. I think a lot of the valuation pumps have been happening primarily because of all this bullish sentiment around AI. And I think AI is definitely a future, but at the same time, we have to also remember that the markets can get a little bit a bit irrational. And that's where we have to just take a pause and be like, look, I think AI is the future, but is it worth paying a triple-digit PE for a company that's already run up so much? And do I think that, it's going to keep going? Now, some people are saying, yeah, absolutely, that's the way to go. But I personally think that easy money has already been made in the tech sector. There's not a lot of upside, in my opinion, because the value was really the time to capture value in the tech sector was last year, man. Like the end of 22 and the beginning of 23 was like, oh, mamma mia. We freaking killed it. Like Absolutely. My portfolio is up like 300% because of that.
Give me goosebumps.
Yeah.
It was a wild time. Like that. Talk about easy money. Like Chris opened the stream with talking about. There's times when you need to lean in. There's times when things are down 80%, and you can, some of them deserve to be down 80%. But I remember having conversations with Chris and many others to say it doesn't make sense, right? Like some of these companies being down 80%, they're making money. They're being treated like the companies that aren't making money, these zombie companies. Lean in. And those people that did, some of my accounts were over 100%. Another one was over 70%. I think even my 401k was up over 30% or something like that. And that's mostly just the S&P. But it just talks about sometimes you just get lucky and you need to be time in the market. And very rarely, I mean, talk about easy money. There's going to be times where 3 out of 5 years or sometimes 4 out of 5 years, the market's going to go up. And then there's unfortunately going to be the 1 year that puts a Debbie Downer on things. And then you're like, so everyone's always trying to wait for that 1 year. To me, specifically when it gets to this, unless you're watching this like a hawk and you're able to really make a pivot on a dime, just buy the S&P and just buy high quality stocks, because 4 out of 5 years, it's likely to go up, right? And I'm not trying to just say it's that easy, but I think sometimes people get smart to the player educated enough where they make bad decisions because they think they know enough. But in reality, just like how I know this exactly for myself, is you're always going to be learning something. There's always going to be something that transforms, changes in the market that you never knew before. Not only that, but just industries change. Like, who would have thought, in the 80s and 90s, the right thing to be buying was oil and industrial conglomerates, right? The computers, nobody really thought were, some people were thinking, okay, maybe computers are going to have a big deal, but to the extent that they do today, probably not. And now you look at the top 10, who would have thought that Nvidia would have just came out of absolutely nowhere and gotten $3 trillion valuation? Maybe some people did, but I remember thinking like back in 2014, 2015, when Nvidia started becoming a thing and people used to start using graphics cards and things like that, I was just like, all right, cool little niche, but I don't ever see it being a massive company. Well, who's an idiot, right? Like
Dom Rinaldi did. Dom Rinaldi. We gotta clap for him, bro. Dom has always been on the Nvidia train. I don't even know if he posts anymore because he's like a multi-millionaire at this point with all his Nvidia, probably.
That's true.
But look at this, man. This is the other thing that every time I look at this, it's just my jaw drops. This right here is the Mega Cap 8, which is the Google, Amazon, Meta, all the main guys. What percentage of the S&P 500, which is the 500 largest companies in the US, they make up about 30% of the index right now. In 2013, they only made up about 5 or 6%. Like, come on, look at this. Beast mode. All you have to do is just
it's twofold. It's twofold, right? It's these guys have grown astronomically. And then the other part is the other guys have kind of just been flat, if not gone down slightly. So that's why the price, if everything came up in tandem and like grew at a decent pace, then I think that the actual percentage would be closer to 15 to 20%. But everything else has lagged. So the other 492 stocks have lagged so drastically that it's what's been able to and a lot of those companies are trading at between 10 and 15x multiple. And then you look at, a lot of these Mag 7, Mag 8 companies, and they're trading at 25 plus. And that's what drags the majority of the earnings up, because you have 30% trading at 25 plus price to earnings, and you have another. And then you look at the price to earnings, kind of that graphic that Chris was showing with the Bollinger Bands almost, but more specific towards earnings. That was showing that you kind of had a 20x, 20 to 25x sort of price to earnings multiple in the market at the moment. And a lot of that's driven specifically by the Magnificent Eight. Yeah. So
the one thing just to keep in mind, though, is that because of this, I feel like we're getting some concentration risk. Now, what does that mean? If all of the growth that we're seeing, if it's being powered, like 30% of the market is being powered by 8 names, that means that these 8 names carry a significant amount of weight in the index, which means that if there's any sort of retracement, even among a few of these guys, or underperformance by a few of these guys, you can see a violent move down. So what we saw in 2022 was this violent move down where the tech sector became unloved, right? And so look at what happened with the S&P 500. The S&P 500 took a nasty dip going downward. Why? Because a lot of the growth names were sold off, right? So you had Meta, Apple, Google, all of them. They got sold off, and that's why you saw this underperformance by the S&P. And the thing is, that whole episode, it took almost a year to play out before we ended up hitting a bottom. So my thing is, right now we have to keep our eyes very closely on these mega cap 8 companies. So if there's any weakness in just a few of them, we could see another dip like this again. Now, I'm not saying it's guaranteed to happen, but it's a worrisome thing. I'm not a fan of concentration, too much concentration risk. You typically want to see, like a even out market where, one particular sector isn't driving majority of the growth, and the good thing is, this is where we might actually see some opportunity. So if you look at it on a forward basis, the S&P 500 on a forward basis, it's okay. Like, it's not like bad, but margins are expanding here and there. Margins on the mega cap 8, of course, are just out of this world. Where was this performance relative to the S&P 500? Yeah, I mean, look at this performance relative to the general index. It's just, it's crazy, man. It's crazy. Where was the damn PE forward earnings? No. Yeah, and so this one right here, year to date, Nvidia is up 161%. Meta's up 42%. So this right here, Nvidia, the one thing I'm worried about, Matt, and this is something that we just have to keep in mind, this is cyclical, okay? I know a lot of people are saying that Nvidia is always going to keep going up and to the right now. The thing is, the industry that they're in is semiconductors. It's a very cyclical business. I don't think that this growth is going to last forever. And when the growth starts to weaken, I think we see a dramatic pullback in the stock. But now, because it's such a large component of the S&P, it could drag a lot of the S&P as a whole down with it. So maybe we don't want to necessarily be in the index right now. Maybe it's sometimes a good idea to be kind of chilling in some individual names that are undervalued instead of being in the general market index. What do you think about that?
I think there definitely is room for a pullback. I just don't know how big it's going to be, and I think I want to say there is going to be pullback for sure. The thing that I just don't understand is with the loosening of interest rates, that will allow some small caps and medium caps and even some smaller large caps to go back to work and give them access to some working capital at a cheaper interest rate comparatively to where some of them have been maybe over the past 4 years, 3-4 years. And with that, you'll also see the Magnificent Seven likely pull back a little bit or slow down. So I don't know. My thing is that they're going to partly offset each other, but I don't think they're going to fully offset each other. And I think that that's where you're getting to, is that you're going to see some of these things fall from heaven and you're going to see some things come up from the depths of hell. But at the end of the day, you're still going to see probably a large retracement. Now, what is actually fair value? I don't know. It's been a while since I've looked at actually what the actual S&P earns. But it gets so skewed once again by the massive growth that we've seen from Amazon Cloud, Google Search, and this massive 20% 30% year-over-year growth that we've been seeing from these monsters, and shit, don't even get me started on Nvidia, that it's hard to interpret that if there is a pullback, like, does that mean that's they just go to zero growth, or does that mean, they actually become anemic in growth? I think it's hard for me to say. I mean, but the thing is, even if they go to zero growth, you think about how a lot of these Magnificent Eight companies are valued. They're valued at 25 to 30x earnings. So if they have zero growth, they're going to have to come down 30, 40% for it even to justify its current price. You know what I'm saying? Like, if you have zero growth, you should probably be at 15x earnings. Maybe in a reference case, some might say you should be at 10x earnings. Some might say if you have a premium business and you have just above zero growth, then maybe you can warrant a 20x earnings. And if you have a superior premium business, maybe you could warrant a 22x earnings. That would bring a lot of these companies down 20, 30% very quickly. And that would bring down obviously 30% of the valuation of the S&P 500 with it. But will that be offset by the potential growth or the revaluation of some of these smaller companies? That's hard to say. I haven't done enough due diligence, and maybe it is something I need to do.
I'm loving this Nvidia run because the more it runs, the cheaper the puts that I want to buy get. So, because I am going to short this bitch. I know I'm shorting it eventually, but I'm not gonna be stupid about it and like go naked short. But I am developing my own custom strategy on how to do it with a decent valuation reset. So we'll see. It's a combination of timing and a lot of other things, but I'm gonna come to the point where it's gonna start making sense to buy some selective strategies around this. Because I mean, when a bubble is happening, no one says it's a bubble. Everyone's like, "Oh, were you stupid? It's not a bubble. Like, you can't predict the bubble. You're not smart enough to predict the bubble." You can tell there's signs that there's a bubble brewing, And right now, Nvidia is a bubble. I'll be honest. I know I'm probably going to be wrong for the next year, maybe even two. But Nvidia is a goddamn bubble. Everyone knows it. No one wants to say it. Everyone's still on this AI hype train. Like, oh my God, AI is going to be the greatest thing in the world. Yes, the internet was going to be the greatest thing on the planet, but it didn't make sense to freaking buy something that was cyclical and overbid for it. So I think a lot of these companies that are getting this AI tailwind, they're all going to get smashed along with it. And when it does happen, I'll be there to pick up the pieces. So,
but I guess my question is it going to be a slow?
ET FaceTime said it. And when Huang started signing Tata's dead giveaway.
Yeah, when he became an absolute rock star overnight, and yeah, exactly, signing Tata's. That's fucking hysterical. But I guess my question is, do you think it's going to be a slow train wreck, or do you think it's going to be, for example, what happened to Enphase? 40% of the revenue dries up in a quarter. Where they're predicting that it's going to continue to go. You know what I mean? Because Enphase was in a similar position 2-3 years ago where they were exploding in terms of revenue growth, and everyone was just like, Enphase to the moon, right?
Yeah. I'll tell you exactly the scenario that I see. I see, number one, the hyperscalers. They don't see as much value in adding more NVIDIA chips, okay? They've gotten about 80 to 90% of what they wanted to accomplish done already. So they say, you know what? Maybe we don't need as many chips going forward from NVIDIA. So they start to kind of slow up their demand. That demand slowdown eventually makes its way to TSMC, and TSMC says, wait, we got all this additional inventory. And the reports come out that, hey, NVIDIA, there's a lot of inventory. And now if you want a GPU cluster, we got you very quickly. And then all of a sudden, you start to see demand constantly drop, and then pricing power starts to erode, in which case now the NVIDIA is able to charge, I think, $40,000, $50,000 for one of these things. That drops to like 20. So now your profit margin gets compressed. And then all of a sudden now everyone is just dumping NVIDIA because they're like, oh my God, growth has slowed down. Oh my God, they're going negative on growth. And then everyone who bought at the peak is going to try to get out the door and then crash. And then what happens? The general market crashes. The general market crashes, which means people are like, oh my God, maybe we don't need to spend as much on AI initiatives, right? Because our stock is down and our portfolio, I mean, our additional cash flow is starting to dissipate, which means now you've got the super cycle of people trying to get out of the AI hype cycle. Very similar to the .com bubble, where everyone's like, like the internet is the future, and no one disagreed with that. But it also didn't make sense to have diapers.com and blah 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 blah. Right now, I'm seeing like every other company right now is a fucking AI company. They come out and they're like, we make rubber dog shit with AI. And every single company, even in the S&P 500, has to have an AI strategy right now, even if AI isn't even fucking really helping them at all with their business practices. It's just everyone is in exploration mode, so they're willing to pay for all the uptake. And then all of a sudden, when this shit ends, everyone's like, oh my God, what's going on? And I know a lot of people are saying, I don't think Nvidia is slowing down anytime soon. I agree. You could be in a bubble for quite some time. It's just a matter of time, like when it happened. So when the housing market was in a bubble and Barry was going around to people and being like, hey guys, listen, I want to buy puts on, the housing market. People laughed at him because they're like, oh, this is not a bubble. The last thing that happens is people actually calling a bubble, it actually happening, So I say we take a break. Yeah.
Season 3. So, no, I'm just kidding.
I'm not, by the way, this is not me saying we need to short Nvidia anytime soon. I think there has to be some concrete data that comes out that the general market is missing. And based on that is our alpha. Now, what does that mean? That means making sure that we are keeping a track of AI, chip inventories. We're also making a check around the S&P 500 to say what kind of spend is every company willing to make on AI? Because if we see that companies are guiding for lower expenses on the back of AI spend, saying, yo, we're sacrificing some of our AI initiatives in order to maintain profitability, that could be a good sign that, hey, maybe we're at a top. So just like how in the Big Short, these guys did the work. They went to Florida. They were looking at the houses. They went to the stripper, and basically I need to reach out to my contacts in the stripping community and figure out, like, hey, has the Nvidia execs, have they stopped coming in lately?
But I hear what you're saying though, Chris, because I mean, look at even Tesla to an extent was saying we're not going to buy all these damn chips from Nvidia. We're going to try to create them in house. You have Google trying to do the same thing. Apple, for example, when they were trying to do the whole Qualcomm issue that would happen in the early 2010s, they were saying, shit, they're making so much money off of us, we'll make our own chips. And then you saw them start making the M1 chips, the M2 chips. They're trying to make sure that they aren't reliant on another company, that they can be self-sustaining. That's all it is in the long term. Is all these companies are just trying to survive. Yeah. And I think a lot of times people forget, that that's all being a company is. You can win one quarter, but it doesn't necessarily mean you're going to win the next. And it's about innovation and keeping up with the Joneses at some point, and not being in a place where you put yourself in a bad situation. You become completely reliant on Nvidia. They can squeeze you and squeeze you and squeeze you to the point where you become basically a bag of worthlessness, and you no longer can innovate in your own organization. And next thing you know, Nvidia completely destroys your business because they can squeeze you out of margins and God knows what else, right? So I think right now Nvidia is having their day. I'm not saying that they're done. They've always continued to do extremely well, and have surprised me over the past 10 years. That's for damn sure. But I think that doesn't mean that somebody isn't going to come out with their own opportunity in chips. Like look at Facebook, right? They're spending billions, tens of billions of dollars a year. You don't think that they're going to try to come up with maybe potentially their own chip that is specific towards what they're trying to focus for, and try to cut some of that margin? And going back to the one piece, I will say I agree with you. The chips will probably get cheaper, 40,000 today, 20,000 tomorrow. But also you have to think they'll be able to shrink the costs that make that as well, right? But I agree with you. It doesn't mean that overnight they're going to lose 50%. They might lose 50% of the revenue, let's say, but they're going to be better about understanding how to make those things, and they're going to get more efficient at it. So it's not like they're going to immediately lose it over time. But even still, like if you think about it, if you lose 50% of your revenue, you go from 40,000 to 20,000, that revenue is gone, right? So even if you were to shrink the amount of costs that it take, let's say it cost $8,000 before and it costs $4,000 now, there's a literally I don't want to say breaking point. What's the word I'm looking for? There's basically a line where you can't get any cheaper, but yet the chips and the competition will always be there. So the revenue will always get less and less depending on what kind of chip it is, right? It's just law, right? The semiconductor laws that we've always kind of had, like things are always going to get 1.5 times or 2.5 times faster within every 2-year cycle. So I'm just curious to see how it works over time.
Yeah. Whatever, we'll see, man. I gotta head out though. It's been an hour and 20 minutes.
Yeah,
so,
man.
Yeah.
Good chat.
All right.
Cool.
Let's reconnect on Sunday.
Sounds good.
And yeah, like I said, that right now there's just not a lot of opportunities that I see other than the ones that we have. So let's stick with it, and we'll see when a good time is to short Nvidia.
Hey man, we've done the spreads to the upside. There's always the opportunity spreads to the downside.
Yes, sir. Yes, sir.
All right, guys. I'll talk to you guys Sunday. Cheers, Chris.
Later.
Thank you for everything always. Cheers.
Take care.